All right, let's dive into something that might seem a bit daunting at first.
Okay.
Inheritance tax, and how the UK's property relief system is getting a shakeup.
Yeah.
Specifically, we're looking at some big changes brewing for business and agricultural properties.
Yes. These changes are quite significant and could have a real impact on your financial planning,
Yeah.
especially if you're thinking about passing on a farm or a business.
Right, because who wants a huge tax bill looming over their heads, right?
Right.
So we've got this recent consultation document that basically lays out the groundwork for what's coming in April 2026.
Yeah.
The big headline is that we're moving away from the traditional 100% relief model for these types of properties.
That's right. Instead, they're introducing a combined £1 million allowance for agricultural and business property.
Okay.
Now, anything below that £1 million threshold will still get 100% IHT relief,
Okay.
which is good news.
Yeah.
But what's really interesting is that anything above that limit will only receive 50% relief.
Okay, so that's a pretty big change. But before we get lost in the details,
Yeah,
can we take a step back and make sure everyone understands what IHT relief even means?
of course.
Just in case someone's tuning in who's not a total expert on UK estate planning.
Inheritance tax, or IHT, is essentially a tax on your estate. That's everything you own.
Right.
When you pass away, if your estate is valued above a certain threshold, currently £325,000,
Right.
then your beneficiaries will have to pay a 40% tax on the amount above that threshold.
Right. So imagine a scenario where someone inherits a family farm worth £2 million
Right.
without any relief.
Yeah,
They'd be looking at a hefty tax bill on a large chunk of that inheritance.
exactly. But that's where these reliefs come in.
Right.
Agricultural property relief and business property relief are designed to reduce or even eliminate that tax burden on certain types of assets.
So in our farm example, under the current system, the entire value of the farm could potentially qualify for 100% relief, meaning no inheritance tax at all.
Precisely. But with these new changes, only the first £1 million would be completely exempt.
Oh, okay.
The remaining £1 million would be taxed at 50%,
Right.
which could still amount to a substantial sum.
So it's safe to say that this £1 million allowance is a game changer.
Absolutely.
And it's definitely something everyone needs to be aware of.
And to complicate things further, there are actually two separate £1 million allowances to keep in mind.
Okay.
One for individuals and one for trustees.
Wait, hold on, trustees.
Yeah.
That's a whole other level of complexity, isn't it?
It can be, but essentially a trustee is someone who manages assets on behalf of someone else.
Okay.
Think of it like a guardian for someone's wealth.
Right.
Often assets are placed in a trust to protect them or to manage them for someone who might not be able to do so themselves.
Okay, that makes sense. So how does this £1 million allowance work differently for individuals versus trustees?
Well, for individuals, that £1 million allowance is applied against the total combined value of their estate.
Okay.
That includes everything, property investments, even lifetime gifts they've made.
So if someone has a business worth £800,000 and a home worth £400,000,
Yeah,
their total estate value is £1.2 million.
correct.
They'd get 100% relief on the first 1 million and then 50% relief on the remaining 200,000.
Exactly. Now, for trustees, it's a bit different.
Okay.
That £1 million allowance is applied separately to something called exit charges,
Okay.
which essentially means when assets are taken out of a trust
Okay.
and to 10-year anniversary charges.
Okay. So let's break that down a bit. What exactly is an exit charge?
An exit charge is a tax that's levied when assets are removed from a trust.
Right.
Let's say someone sets up a trust for their children and puts £500,000 into it.
Okay.
Years later, when the children are older, they decide to take that money out of the trust.
Right.
That's when an exit charge would kick in.
So with the new rules, the exit charge would be calculated on the full £500,000,
Yes.
but they'd get 100% relief on the first 1 million because of the trustee allowance.
Exactly. And it gets a little more complex when you start dealing with larger amounts or multiple trusts.
Right.
But that's the general idea.
Got it. So we've got these two separate £1 million allowances.
Yeah.
One for individuals based on their total estate, and one for trustees applied to each exit charge.
You got it.
And just to be clear, this is all kicking in from April 2026 onwards, right?
That's right. So we've got some time to prepare, but it's definitely something to start thinking about now.
Especially if you're planning to make any significant gifts or transfers before these changes come into effect.
Right.
Because those gifts could potentially eat into your allowance down the line.
Exactly. And that brings us to another important aspect of these changes.
Okay.
Potentially exempt transfers, or PTs, as they're commonly known.
Okay, PETs. That sounds cute.
Yeah.
But I have a feeling it's not as simple as it sounds. What are we talking about here?
A potentially exempt transfer is basically a gift you make during your lifetime.
Okay.
The key is that if you survive for 7 years after making that gift,
Right.
it becomes exempt from inheritance tax.
Okay.
But here's the catch.
Okay.
Even those PETs are factored into your £1 million allowance.
So let's say someone gifts their child £200,000 worth of qualifying property today.
Right.
They survive for 8 years, so the gift becomes exempt from inheritance tax.
Yes.
But when they pass away, they'll only have £800,000 of their £1 million allowance remaining.
That's right. So it's not just about what's in your estate at the time of your death.
Right.
It's also about any qualifying property you've gifted during your lifetime.
Wow. It really highlights the importance of careful planning, doesn't it?
It really does. Every decision you make now could potentially impact your inheritance tax liability in the future.
All right, so we've covered the big picture.
Yes.
The shift from 100% relief to a £1 million allowance. The difference between the individual and trustee allowances.
Yep. And even touched on potentially exempt transfers.
Yes, and I think it's important to emphasize that this is just scratching the surface.
Right.
There are layers of complexity within each of these areas that we'll unpack as we dive deeper.
Right, because we haven't even gotten to things like apportionment
Yeah.
or those special trusts you mentioned earlier.
Exactly. There's a lot more to uncover.
Okay.
And we'll make sure you have a clear understanding of how these changes might affect you personally.
Great, because knowledge is power, right?
I couldn't agree more.
And who doesn't want to feel empowered when it comes to their financial future?
Yeah.
All right, listeners, let's take a quick breather, and then we'll come back and delve into the specifics of how this £1 million allowance works for individuals.
Welcome back. Before the break, we were discussing how these new IHT rules will work for individuals.
Right, we were just starting to unpack how that individual £1 million allowance works in practice.
Well, it's not a one-time thing. You actually get a refresh every 7 years.
Or a refresh, so it's not like you use it up and that's it.
Yeah.
It's exactly. Think of it as a rolling 7-year window. Let's say you gift your child £200,000 worth of qualifying property today, and then in 4 years you gift them another $300,000.
Okay, so you've used up £500,000 of your allowance.
Right, but after 7 years from that first gift, the £200,000 is basically refreshed, and you have that portion of your allowance available again.
Ah, so it's not a constant countdown from the moment the rules take effect.
No, it's more dynamic than that, and this is where those potentially exempt transfers, or PTs we mentioned earlier, come into play.
Right, those gifts you make during your lifetime.
Exactly. Remember, even if a PET becomes exempt from IHT because you survive for 7 years after making the gift, it still affects how much of your allowance is available at any given time.
Okay, so let's say, hypothetically speaking, I'm feeling very generous and decide to make multiple gifts over several years. How would all of that be calculated against my allowance when I eventually pass away?
Well, it's all about chronological order. The earliest gifts would be deducted from your allowance first. So in your hypothetical scenario, the gifts you made earlier in that timeline would be the first to chip away at your allowance.
I see. So timing really matters here. But what happens if someone has qualifying properties spread across different places? Like, what if they have some assets in a trust and some held directly in their name?
That's where apportionment comes into play, essentially. If you have qualifying property in multiple locations, maybe some in the trust, some as gifts with reservation, you have to figure out how that £1 million allowance is divided up.
Gifts with reservation. What's that?
Ah, good question. It's basically a situation where you give something away, but you still benefit from it in some way. For example, imagine gifting your holiday home to your children, but continuing to use it for vacations that could be considered a gift with a reservation, and it could affect your IHT liability.
Okay, that makes sense. So back to apportionment. How does that work exactly?
It can get a little complex, but the general principle is that the allowance is allocated proportionally based on the value of the qualifying property in each location.
So if someone had £600,000 worth of qualifying property in a trust and £400,000 held directly, the allowance would be split 60-40.
Exactly. And here's another important point, that individual £1 million allowance isn't transferable between spouses.
Really? So even if my partner passes away and didn't use their full allowance, I can't inherit that leftover bit?
Unfortunately, not each individual gets their own allowance, and any unused portion doesn't transfer to the surviving spouse.
Wow, that seems a bit unfair. It's almost like a use it or lose it situation.
In a way, yes, it really underscores the importance of planning ahead and potentially making use of that allowance during your lifetime.
Okay, so we've covered the individual allowance in some depth now. I think it's time to switch gears and talk about how these changes affect trustees.
Sounds good to me.
Remember we mentioned earlier that trustees get their own separate £1 million allowance, which applies to those 10-year anniversary charges and exit charges we discussed.
Yes. And there's a particularly significant change coming specifically for exit charges from April 2026. No matter when an exit charge occurs, it will be calculated based on the full value of the property before any release is applied.
So if an asset has increased in value significantly since it was placed in the trust, that could mean a much bigger tax bill, right?
Potentially, yes.
Yeah.
Even if the property ultimately qualifies for relief, that initial calculation based on the full value could lead to a higher tax liability.
That's definitely something for trustees to be aware of. It seems like a lot of these changes are making things more complex.
I understand why you might say that, but the government's intention is to create a fairer system that prevents people from exploiting loopholes.
Right, so how does all of this affect existing trusts? What about those that were set up before these changes come into effect?
That's a great question. There are transitional rules in place to handle this situation. Basically, any trusts that were in existence before these changes take effect will get their own £1 million allowance starting from April 6th, 2026.
Okay, that makes sense. But what about if someone adds more qualifying property to an existing trust after that date? Does that change things?
It depends on the timing. If they add property before October 29th, 2024, they're in the clear. The trust will still have its own separate allowance. But if they add more qualifying property after that date, then they'll be subject to those anti-fragmentation rules we'll be discussing soon.
Ah, yes, those anti-fragmentation rules. It sounds like we're entering a whole new level of complexity here.
We are, but don't worry, we'll break it down for you. Essentially, these rules are designed to prevent people from trying to game the system by spreading their assets across multiple trusts to try and maximize their relief.
So in the past, someone could be quite clever and say, set up 5 different trusts, each holding £1 million worth of qualifying property, thinking they'd get that full 100% relief on the entire $5 million.
You got it, but those days are numbered. The government is introducing a single £1 million allowance for multiple trusts created by the same person after October 29th, 2024.
So if someone tries that same trick now, they'll hit that £1 million limit, and any subsequent trusts will only be eligible for the 50% relief.
Exactly, and to make things even more interesting, there's also a related property rule to contend with.
Okay, related property, that sounds intriguing. Tell me more.
This rule basically says that if you have assets spread across multiple trusts, but those assets are essentially connected or related to each other, they'll be treated as a single entity for valuation purposes.
So if someone tries to get sneaky and divide up shares in a company across 3 different trusts to avoid that controlling interest label and get a lower valuation,
They're out of luck. The related property rule means that from April 6th, 2026 onwards, those shares will be valued as if they were all held together, eliminating that potential discount.
so it's all about preventing people from artificially lowering the value of their assets by spreading them around.
Yeah.
It seems like the government is really clamping down on those who try to bend the rules.
These anti-fragmentation measures are a clear signal that they're serious about ensuring a fair application of these tax reliefs.
Okay, so we've covered the basics of how the individual and trustee allowances work and even delved into the fascinating world of anti-fragmentation. I think it's time to take another short break. When we come back, we'll tackle those special trusts you mentioned, which seem to have their own set of rules altogether.
Sounds good. We'll be back in a moment to shed some light on those unique situations.
All right, we're back and ready to tackle the final piece of this inheritance tax puzzle, those special trusts you mentioned earlier.
Yes, these trusts have some unique characteristics that set them apart from the more common types we've discussed so far. Things like temporary charitable trusts or employee benefit trusts fall into this category.
Right, and you mentioned that they don't have those typical 10-year anniversary charges we talked about, but they do have their own set of exit charges.
Exactly. And starting April 6, 2026, those exit charges for special trusts will also be subject to the £1 million allowance. So there is some consistency there.
Okay, so if assets are removed from a special trust after that date, they'll benefit from that allowance just like other trusts.
That's the idea. However, there's a crucial difference when it comes to how that allowance works for special trusts.
Okay.
It doesn't refresh every 10 years once it's used up. That's it.
Oh, wow. So it's almost like a one-time deal for special trusts that makes planning even more important in those situations.
Absolutely. You really need to consider the long-term implications and
Yeah.
how much of that allowance you might need to use up front.
Now, you mentioned a couple of specific types of special trusts that our listeners might encounter.
Yeah.
One was the age 18 to 25 trust, which is designed to support young people who've lost a parent.
Yes. These trusts are structured in a way that protects the assets until the beneficiary reaches a certain age,
Yep.
typically between 18 and 25.
Right.
This helps to shield those assets from that 40% IHT charge until the beneficiary is older and perhaps better equipped to manage that inheritance.
Right. And I remember you said there's an exit charge when the beneficiary eventually receives those assets.
That's right. But the good news is that the rate for that exit charge is capped at 4.2%,
Right.
which is much lower than the standard 40% IHT rate.
Okay. That's a relief, but how does the £1 million allowance work in this scenario?
Well, in this case, each beneficiary of an age 18 to 25 trust gets their own £1 million allowance to apply against that exit charge. So if there are multiple siblings, for example, they each have their own allowance to work with.
Wow, that's great news. No need to worry about one sibling using up the entire allowance and leaving nothing for the other.
Exactly. It's a much fairer system for those types of trusts.
All right, the other type of special trust you mentioned was the QIIP trust, or qualifying interest in possession trust.
Wow.
I have a feeling this one might be a bit more complex.
It can be, yes. QIP trusts are often older trusts, perhaps set up before 2006, or they might be designed for individuals with disabilities.
Okay, and the key difference with these trusts is that the beneficiary who has a qualifying interest, meaning they have a right to income from the trust or the right to live in a property held by the trust,
Right.
is treated as if they own those assets for IHT purposes.
That's right. So rather than facing those regular 10-year charges, the trust assets are essentially considered part of the beneficiary's individual estate when they pass away.
So it's almost like those assets are boomeranging back into their estate when they die, and I imagine that's where things get a bit tricky with the new £1 million allowance.
Yes, it does add a layer of complexity. If the beneficiary still holds that qualifying interest when they die, those trust assets are potentially subject to that 40% inheritance tax.
Right.
And if they happen to transfer that interest within 7 years of their death, those assets are also brought back into the estate for tax purposes.
Wow, it's like those assets have a mind of their own, but how does that £1 million allowance fit into all of this?
Well, for QIP trusts, that individual £1 million allowance only comes into play if the beneficiary dies on or after April 6th, 2026.
Okay.
And it applies to any qualifying agricultural or business property that was held within the QIP trust.
So timing is crucial here, just like with everything else we've discussed today.
Absolutely, and it gets even more granular than that. If there were any lifetime transfers of qualifying property from the QIP trust, those transfers would also be considered.
So it's not just about what's in the QIP trust at the time of death,
Right.
but also what might have been taken out of the trust during the relevant time period.
Exactly, and remember that £1 million allowance, or whatever portion remains, after accounting for things like potentially exempt transfers, will be divided between the qualifying property the beneficiary had an interest in within the QIP trust and any other qualifying property held directly in their estate.
This is definitely a segment where seeking professional advice is crucial.
Absolutely.
Navigating the intricacies of QIIP trusts and the new allowance rules can be a minefield.
I completely agree. A qualified financial advisor can help untangle the complexities and create a tailored plan to minimize potential inheritance tax liabilities.
All right, so we've covered a lot of ground today. We started with the big picture, the shift from 100% relief to a £1 million allowance, and then explored how that allowance applies to individuals, trustees, and even those unique special trusts.
We also delved into the complexities of potentially exempt transfers, the concept of apportionment, and the government's efforts to close the loopholes with those anti-fragmentation measures. It's been quite a journey.
It really has. But I think it's safe to say that anyone listening now has a much better understanding of these upcoming changes and how they might be affected.
Absolutely, and that's the most important thing. Knowledge is power. And the more you understand, the better equipped you'll be to make informed decisions about your financial future.
Exactly. These changes might seem overwhelming at first, but by breaking them down and explaining the key concepts, we hope we've empowered you to take control and start planning for your legacy.
I think we've accomplished that. And remember, it's never too early to start planning. The more proactive you are, the better positioned you'll be to achieve your goals and leave a lasting legacy for your loved ones.
Well said. And on that note, we'll wrap up this deep dive. Thanks for joining us. And remember, always consult with a qualified financial advisor for personalized guidance tailored to your specific circumstances. Until next time.